Hello everyone. In today's video, we will talk about the craziest investment strategy, and we will try to turn it into a reliable strategy in day trading, and not just for long investment. Yes, it's Oliver Keel's strategy, the clever football guy who won the US Investing Championship in 2020, with a total return of more than 941%. His long-term strategy was adopted by studying the methods of swing trading. And by identifying the entry points above the moving average 200, he also relied on the trend lines and the cup and handle pattern. But to know all this complexity and to reach an easy way to use this strategy, we will explain it step by step with some simple modifications. All these blue lines that you see on the chart are entry points for trades that have been mostly successful, and I showed them before starting the explanation, so you have a little idea what these areas look like. Now let's delete everything and start from the beginning in order to understand everything. This strategy works on very large frames, such as 1 week and 1 month, but in this video, we will use it on a 4-hour frame, as it can also be used on a 1 hour, but this is not recommended, especially for beginners, so we will apply it to a 4-hour. For the indicators, we will use the exponential moving average, and we will use the 10-in-1 indicator. We talked about the benefits of this indicator in a previous video, especially for free accounts on the TradingView. Now we will open the indicator settings in order to activate the 3 moving averages as you see here. But you must make sure that you have chosen the exponential moving average, which is the EMA indicator. The length of the first moving average will be 200 and the second will be 20. As for the last moving average, we will set it to 5, although it was supposed to be 10, but because we used a smaller frame, it is better to be 5. As for the colors, you can choose the colors you want from here. And these are the important settings for this indicator, which is the main indicator in this strategy. Now let's talk about how this strategy works, and let's start by the moving average 200. The first condition in this strategy starts by seeing that the candles have breached the moving average 200 from the bottom to the top, as we see here in this area. And after this condition is met, we will start looking for entry opportunities. Sometimes we may see a false breakout or short-term movement, and we will talk about it as well, but let's follow the rest of the conditions first. After the breakout, we should also see that the moving average 5, which is in green, is above the moving average 20, which is in red. This means that the order of the lines should be as follows. And these are all the conditions for the moving average indicator. Now let's talk about the second part, which is the conditions for the movement of the candles. First, we must see that the candles are above the 2 moving averages, 20 and 8. Second, we must see that the bodies of the candles or their wicks touch one of these 2 moving averages, meaning that the lower part of the candles should be touching the green or red line. Third, after we see one or several candles touching these lines, we need to see that one of the candles has moved away from the moving average 8, and it will be like this candle here, which will also be the target candle. After identifying the target candle, there will be other conditions. The first condition is to see that the next candle has closed at a price level lower than the target candle, meaning that it is shorter than the target candle. The second condition, we have to see other candles that have touched one of the moving average lines, and their closing must also be at a level lower than the target candle. After this condition is met, we will draw a horizontal line above the target candle, and all we have to do is wait for this line to be breached. These were the basic conditions for this strategy, but when trading, we may encounter several other problems, completely different from this simplified explanation, so let's try to see this on the chart and look step by step of these problems. As you can see, I picked a good piece of the chart so we can start explaining the strategy, and then we'll move on to the more complicated places. Just don't be in a rush and try to focus, because we won't leave anything behind. Suppose we were trading here, and we're waiting for the 200 EMA to be broken. A few hours later, the moving average is crossed here at this candle. But to be sure, we must wait until we see the green and red line have crossed the 200 average as well. And here, it was confirmed by the breach of the red line. Now we must see that the candles started touching the green line, and even if it touched the red line, that would be good. As we can see, now the candles are touching the green line, and this is a good sign. All we want now is to see one of the next candles has closed above the green line without touching it, and it is better to have a wick from above. Here we see the emergence of a candle that does not touch the green line, but it is very close to it, and in my opinion, it is not good for entering, so we will wait until we see a better candle than it. Here we see another candle, which is far from the green line, and it is very good compared to the one before it, so it will be the target candle, but the candles that follow it, they should be shorter than it, and they should touch the green or red line. This is good. After the target candle, a shorter candle appeared, and it is also touching the green line, so we will prepare entry, stop loss and take profit orders. The entry will be slightly above the target candle, as we explained in HOFFMAN's strategy, and the stop loss will be at the moving average line 20, which is the red line. As for taking profits, it will be double the stop loss, meaning the risk-reward ratio will be 1 to 2. As we can see, the candles have started to go down, and we haven't reached the entry level yet. Now at this part of this candle, the entry order has been executed, and all we have to do is wait for the first target to be achieved. And here, at this candle, the target has been hit. During this period, waiting for the target to be achieved, there were some other opportunities, meaning that if this opportunity was missed, you can place other orders above this candle here, or even this candle. There are many opportunities, but they must be seized carefully and without haste. Let's move forward and wait for a suitable candle. Here a candle appeared that agrees with the conditions, and all we have now is to wait for the candles that follow it to make sure of the signal. That's good, but let's go back a little bit on this candle. As you can see, the next candle was shorter than it and was also touching the green line, so we will place an entry order above the wick of the target candle, then we will wait for the price to reach the entry area in order to enter. The stop loss will be at the moving average 20, and the take profit will be double. Now at this candle, the buy order has been activated. And here, at this level, the target was also reached. Here too, we note that there are other candles that are valid to enter, and they can be used in case we missed the candle that we entered. But not this one. As you can see, it is very close to the green line. But let's see another example. Here, we find a candle that has all the required conditions, as well as the candle that follows it. Although its upper wick is very short, and this is not a good sign, but it will be the target candle, and we will place the entry order above it. And as we said, stop loss at the red line, and take the profit will be by multiplying the value by 2. Okay, now we will wait for the price to reach the entry level, which is a little above the target candle. It seems that we lost, and it seems that the price has hit the stop loss as well, but no, this did not happen, and we did not lose anything, because the price did not reach the entry level, and this is one of the features of this strategy. In most cases, when the price exceeds the level of the target candles, it will continue to rise, because the target candles are considered resistance candles, especially those with a wick from above, and if their upper level is broken, the price will go up. Now that a red candle appears below the green and red moving averages, this signal will be considered consumed and must be cancelled. Even if the next candles have risen and reached the entry level, it must be cancelled and wait for another target candle. We notice that the trend is heading downwards, but let's continue to see some other examples. This candle may be the target candle, but no, it is not. Let me explain this. When a length of the lower wick is equal to or less than the distance between the end of the wick and the green line, the distance is considered short, and target candle is not good to enter. Okay, let's move forward to see more examples. Here too, we may see a target candle, but the arrangement of the lines is wrong. The green line should be above the red, and not the other way around. Here is another target candle, but as you can see, the distance is very short and it almost touches the green line. Here too, we may think that this is the target candle, but no, it is not. Look at the overlap of the candles that occurred before it and the distance we talked about, as well as there are many things that make it a candle that is not guaranteed to be the target candle. Although there was a rise after that candle, but in my opinion, it remains invalid to enter. Well, to get rid of all these ramifications and get pure and accurate signals, we will use another indicator, and this indicator will be the MACD indicator. We open the indicators, search for it, and then apply it. Now go to the settings, open the input section, and do not change anything except the time frame, choose 1 day. I think that everyone knows how to use the MACD indicator, but to be sure, when the blue signal line is below the red MACD line, we will consider that we are in a downtrend and we will not enter any buying positions. And this means that we have gotten rid of the complex signals that were here. But when we see that the blue line crosses the red line heading up, like here in this area, we will start looking for long positions according to the strategy that we have explained. In this area, we entered into only 2 trades, but as we said previously, there are several other opportunities that we can enter, such as this candle and others, but because we were waiting to take profits, we could not use them, although they were valid for entry as well. Well, this was a simple explanation of the strategy that Oliver was using, but with some modifications in the time frame and risk-reward ratio. This strategy still lacks a lot, such as drawing some trend lines and using patterns, but to simplify the idea, this was part of the explanation, and we will try to delve deeper into it in the next videos. Before we finish the video, here are some tips that will help you use this strategy in an accurate manner. For example, drawing a vertical line at each intersection that happens to the MACD indicator will be good for identifying the trading areas. The second thing is to use the MACD indicator over a 1-day period to confirm the breakout of the 200 moving average, as we see here. As it can also be used to identify false breakout sometimes. Always try to find the candles that will be the target, and it doesn't matter, red or green, the important thing is that they have an upper wick. And remember, the further away from the green line, the better. Also, try to use a trailing stop-loss orders so that the profits are greater and the loss is less. This strategy can be used on short positions as well, but make sure the trend is below the moving average 200. Finally, don't forget to subscribe, because we will continue to explain it in the upcoming videos. Thanks for watching, and good luck.